Hey everybody, welcome to Mortgage Today for Thursday, January 4th, 2024. And oh, what a day it was. UMBS were down in the first hour of trading. The 6.0 coupon was down 19 basis points and the 5.5 was down 30. Bonds were already weaker in the overnight in a move led by stronger losses in Europe. The AM economic data wasn't doing anything to help the issue with jobless claims coming in very close to breaking below 200,000, which is the lowest reading since mid-October. ADP employment came in at 164,000 versus a 115 forecast. It was 101 previously. Leisure and hospitality added 59,000 jobs. Education and health added 42,000 jobs. Construction added 24,000 jobs. Jobless claims came in at 202,000 on a 216 forecast. It was 220,000 previously. Continuing claims came in at 1.881 million versus 1.855 million previously. Announced job cuts fell by about 35,000 in December, according to outplacement firm Challenger Gray & Christmas. Layoffs have begun to level off and hiring has remained steady as we end 2023. That said, labor costs are high. Employers are still extremely cautious in the cost-cutting mode heading into 2024, so the hiring process will likely slow for many job seekers and cuts will continue in Q1, though at a slower pace. Overall, stronger jobs data this morning has yields on the rise, but investors are still waiting for the unemployment report to be released tomorrow. The FOMC minutes indicated that the Fed isn't quite yet worried about flagging economic growth. Their main focus continues to be inflation, not growth. That said, they do see it appropriate to move the Fed funds rate lower towards the end of the year. Participants judged that the current stance of monetary policy was restrictive and appeared to be restraining economic activity and inflation. In light of the policy restraint in place, along with more favorable data on inflation, participants generally viewed risks to inflation and employment as moving toward greater balance. In terms of inflation, they generally view the supply chain issues to have worked themselves out. They see shelter inflation working its way lower as rents continue to weaken. Services inflation, less shelter, which is largely driven by wage inflation, is still elevated. The Fed Fund futures have begun to take down the probability of a rate cut at the March FOMC meeting. A week ago, they were looking at an 86% chance of a rate cut. Now it's down to 71% chance, which personally seems way too high to me. Gross U.S. national debt has now surpassed $34 trillion earlier this week for the first time, according to a Treasury Department announcement on Tuesday. This is an increase of $1 trillion since September, and a $14 trillion increase since early 2022. So our debt has increased $14 trillion in the last 3 years. That is incredible. The U.S. currently adds roughly $5 billion to its debt each day, and recent estimates suggest the debt will reach $50 trillion by 2033. The federal government will pay roughly $800 billion to service its debt this year, amid higher interest rates equal to approximately 18% of the 2023 federal revenues. Close to $8 trillion of the total debt is intragovernmental, which is debt the government owes itself, the bulk of which comprises trust funds that pay out Social Security, Medicare, and others. Thursday's trading session provided an unpleasant but worthwhile reminder that data dependence cuts both ways in terms of its impact on the bond market. Yesterday's session saw weaker data help rates avoid a break above 4%, while today's data arguably did the opposite. None of the above is a very big deal in the bigger picture, but Friday's job report certainly has the power to change the tone if it falls far enough from forecast. UMBS closed the day down 23 basis points at 101.14 on the 6.0 coupon. The 5.5 lost 31 basis points. So with the 6% ending up at 101.14. That puts us right down here, is basically sitting right on that 25-day moving average, which has been coming up to match the trend line. So this Fibonacci line has been a pretty tough floor and ceiling. So we'll have to see what tomorrow's jobs news say. From Elliot Eisenberg, the Bowtie Economist, we have a great passage here. Of all the FOMC votes cast during Paul Volcker's tenure as the chair of the Fed, which was during the last giant recessionary period that saw a huge inflation like we have today in the early 80s, 10.7% of the votes were dissenting against him. During the Greenspan years, the dissenting vote percentage fell to 4.8%. During Bernanke's time as head Fed, dissenting votes were 7%. And during Yellen's era, dissents remained essentially unchanged at 7.1%. However, since Powell's period has began, dissents have been a minuscule 2.6% of votes cast. So we have a lot of Fed speakers talking, but we really only need to pay attention to Powell. And then we also got a post from our sponsor at thatmakesense.com. This is another great passage from the amazing book Influence by Robert Cialdini, which is talking about social media and likability. Likability was one of Cialdini's main influence factors. So even before social media, it's been all about likability. In the session, we delve even deeper into the intricate web of human persuasion and the captivating aspect of the phenomenon known as likability. So log into thatmakesense.com and find out how you can use likability even more effectively to earn more business.